S&P Global is the best company to have in your portfolio to outperform the S&P 500. It has been coming down over the last month, as we can see, down 6%, and it is trading towards the mid to lower end of the 52-week low. So is now a great time to add this incredible company, S&P Global, into your portfolio. In today's episode, we're going to run through a lot of information. We're going to look at the historical performance of S&P Global. We're going to see how well their top line as well as their bottom line net income is performing over the last 5 years. We're going to see how well is the health of the company, their balance sheet, their total cash versus total debt, as well as performing a essential peers review, looking how they've performed a total return basis against some companies within the same industry. And as always, we will see what are the institutions doing. Are they buying or selling this company? And this will in turn lead nicely into that all-important dividend safety, as well as uncovering some important financial metrics you need to understand before investing into S&P Global. And as always, we will run it through our stock valuation model, getting to our intrinsic value and our acceptable buy price given that important margin of safety. Now, before we take a quick look, it is important to note they are reporting their earnings next week on the 2nd of November, so we can very quickly see how they performed after the last 2 quarters. So in June, they did in fact miss on the earnings per share by 1 cent, 3.13 expected, 3.12 was reported, but they did beat on that top line by around 1.4%. And if we look at March 2023, they beat both on the earnings per share by 8%, as well as the top line by 3%. So it will be interesting to see how they perform. They did slightly miss that earnings per share, but how will they perform when we'll find out this week, and we will touch upon that as well. We can see a year over year on their latest report when June 23, when they released, they did increase their top line, but unfortunately their bottom line did reduce quite considerably. So it will not only be important when looking at their earnings to just look at the top line, the headline statements in fact, but also to uncover a bit more on their year-to-year performance. Now, institutions, what are they doing? Well, 85.5% is institutional ownership of S&P Global. Around 13 billion worth of shares have been sold over the last 12 months, with an incredible 267 bought inflows, as we can see here depicted by the green, by institutions. Very, very high. So institutions do love this company, S&P Global, and we can see in Q2 of 2023, the majority of the buying was done by the institutions. Do bear in mind though, we don't copy what the institutions do. We always need to perform our own due diligence. And one thing to note from this, institutions don't tend to do a lot of buying and selling of S&P Global. They do tend to just hold it, as it is one that they do like quite considerably, as we can see here from this information. Now, in terms of comparing it against their peers in the financial exchange and data industry, we have some well-known companies, CME Group, Intercontinental Exchange, Moody's Corporation, and a few others to note. Now, year to date, how have they performed? Well, SPGI at 2.95% total return, including those dividends reinvested, has in fact been one of the worst performing, if not the worst, out of its peers. But on a 5-year with an expanded horizon, how has S&P Global performed? Well, 108% total return, very positive to see straight away on any type of investment, 108% increase over 5 years. So we do like to see that. But in fact, it is the third best performing in the industry, with MCO Moody's at 123% and MSCI at 249%. Now, as we go along, do let me know if any of these companies you would like to be reviewed on the channel. And as always, do bear in mind, just because we see 108% return from SPGI over the last 5 years, previous historic performance isn't indicative of the future, but it is always good as one extra level of review. So it is down when we take a look on the 5-day and 1 month, but year to date it is up around 2%. And over the last 10 years, shareholders who have been holding this company would be up a whopping 382%. Incredible to see. And if you have your portfolio up that over the next 10 years, then I'm sure you will be very happy. In terms of a yield, what it is offer a just over a 1% yield at 1.05%. And today's episode, we want to understand, are we looking now at a cheap price for S&P Global, where we can essentially expect double this or triple over the next 10 years, as well as seeing our yield on cost move to double digits? Well, in terms of the income statement, how is the company operating profitability-wise? Well, top-line revenue, 6.3 billion in December 2018, and we do like to see around 3 to 7% growth year on year. December 22, nearly double the top line, 11.2 billion, very, very positive to see. And when we take a look on a more granular level, we do see those increases year on year. Again, very positive to see. We do like seeing companies that are fast growing. But can they continue that on the bottom line? Well, 1.9 billion reported in 2018, 3.2 billion in 2022. So again, very positive to see the increase on the bottom line in line with the top line. And again, that increase consistently as well. Very nice to see. Now, what is the safety of the balance sheet looking like? Total cash versus total debt. 1.9 billion in cash in 2018. Latest quarterly report from June, 1.6 billion. So they are holding a slightly lower amount of cash than they did 5 years ago, but still fairly positive. But let's compare that to get a better idea versus the total debt numerically and directionally. 3.7 billion in 2018. Latest quarterly report, 12 billion. So their debt has increased by nearly 4 times. Now, do bear in mind, they did do a merger in 2022 with IHG Markets. So that is something to factor in when we do analyze this company. So lots of positives to take, especially their total return performance. And now when we take a look at that all-important dividend safety and those supporting financial metrics, straight away 99 score, very safe, the highest you can obtain. Market cap just over 100 billion, making it a mega cap company. Now, in terms of a recession, for those that do see one looming, they increased the dividend in the 07-09 period, negative 38% recession sales, which was below the average growth of companies in the S&P 500 during 07-09, which was also in fact negative. Now, latest increase 5.9 in January this year, so we should be expecting one soon over the next few months. Now, this is, in my opinion, positive and negative. Positive for the fact it is above the 4% I always advocate on the channel. 4% was the average inflation rate over the last 10 years. 40 years, in fact. So if you aren't getting that in your dividends, salary, or other income producing assets, then in fact you're taking a pay cut and losing your purchasing power. And a negative in the sense that with the last 5 years, it has been double digits compounded annually, and the last 20, 10%. So we would have liked to have seen creeping up more towards the double digits. But one thing to note, if they do pay an increase in January, which we do expect January 24, they will obtain a dividend king status, as they will have paid increasing dividends for 50 years or more. Now, dividend yield theory states a company is undervalued when that current yield sits above the 5-year average, so we have our first sign of undervaluation. Bear in mind, we don't look at any model in isolation and will draw our conclusions towards the end of the episode. Forward PE, now 25.6 versus 28.4, another sign of undervaluation, and we can see the sector PE considerably lower than that of S&P Global. Now, bear in mind, as we said at the beginning, it is trading towards the mid to lower end of the 52-week price range. But even if it's sat right now at the 52-week low, it doesn't signal undervaluation. Likewise, 52-week high wouldn't signal overvaluation. Now, earnings versus free cash flow. Regular viewers know we tend to ignore the earnings. It is susceptible to manipulation by management through accounting, but the information's there if you would like to use it. Free cash flow below 60% is what we like to see. The reason for this, it means management, in my opinion, have the ability to offer those double-digit increases we love to see. Now, over the last 10 years, it has been below 60% for the majority of the time. Now, the reason why I do say free cash flow over earnings, if you were to look at the 2015 as an investor, 29% perfect, it is below the 60%. But in 2015, the free cash flow, what it would signal is that management were paying out a lot more in dividends than they were generating in free cash flow. So that is one of the reasons why I do prefer the free cash flow. But since then, it's been very positive, 42% in 2022, 24% expected in 2023. So far, so good. And we can see that all-important dividend safety score standing very strong. Earnings per share, again, data available for those that do like to take a look. Free cash flow per share, 158 in 2013, 793 in 2022. Do bear in mind it did fall off. But still, over that 10 years, it's still looking very, very positive. Nearly around 6 times increase on that. So that is positive. 15.5 expected in 2023, so it is still upward trending, which is very good to see, but do keep an eye on that as quarterly reports and annual reports do come out. Sales growth, I always advocate 3 to 7% year on year is what we like to see. Now, nearly every single year they have done that, and even beyond that with the last few years in the double digits, which is very positive to see. A nice large increase in 22. 4.7 billion, so nearly 3 times growth over the last 12 years to 11.2 billion. Again, very, very strong. Now, shares outstanding from 2013 to 2021, they did do share buybacks, returning excess cash, although not massively, to shareholders' pockets. We then did see that merger, which we can see the increase for the shares outstanding from 242 to 319. So I would expect going forwards that they would again start to do share buybacks. Now, ROIC is one of my 7 golden dividend metrics, 10% or more as we tend to stay on the channel. It means management are effectively allocating their capital. 2013 to 2021, it was in the very high 40 to 50%, so very positive to see. It did slip in 2022 to 7%, and I would look to the 2023 annual report, which we should get over the next few months, to essentially show that this was a one-off, and we do see those ROIC back to the regular, very high numbers we love to see for S&P Global. Operating margin, free cash flow margin, a very strong company in terms of the operating margin. From 2013 to 21, it did increase consistently. It did fall slightly in 2022, but still very, very strong. And I would again look to 2023's report to ensure it is a one-off, in fact, and it isn't starting to decrease. Likewise, free cash flow margin, very, very strong and well above the 5% we like to see as a minimum. Net debt to EBITDA, again, we did touch upon that increase in total debt. But then again, we did see a slight drop in cash, although it wasn't a massive worry given the total debt wasn't huge. We can see here the highest we'd like to see for the net debt to EBITDA metric is 3, signaling the number of years it would take the company to pay off all of their debt net of cash on hand. 2022, 1.86, so still significantly lower, with 23 expected to drop even lower at 1.7. So no issues there. Again, we can see reiterated that safe dividend score. And on the right, purely showing us the percentage of a company's financing from debt as opposed to equity. As always, if you are enjoying the content, value is being provided, hit that like button, hit the subscribe and bell button to be continually notified of these videos as they drop to your doorstep. And if you want to grab a copy of the valuation model we're about to run through to get your intrinsic value and acceptable buy price, then do click on the pinned comment below and grab a copy. Now, Graham's valuation, a lot of people ask, why do we sometimes include, sometimes exclude? It is very subjective and some people tend to exclude it completely. However, I do personally like to add it in for the more mature companies. For a company like SPGI, where we do see quite a lot of strong growth in nearly double digits as well, this is one we will exclude. But again, it is very subjective, so you are more than welcome to grab a copy of the model and include this within your own evaluation. So we have the stock ticker, earnings per share, growth rate per analyst estimates with that current yield on AAA corporate bonds. Remember, the higher the current yield goes, the lower the intrinsic value will go. And this has been on a trend to be increasing over the last few months. So this would be the valuation that we would have used if we were included this in our intrinsic value calculation. Now, the multiples valuation model, we have companies in a similar sector and size that we ran through over the 5-year total return analysis. We have the stock price, earnings per share, PE multiple, which we get the average, multiply that by the earnings per share of SPGI, to get a stock price of $268. Now, based on that model, we do see it does look overvalued as it is also below the 52-week low and way below the current trading price. But bear in mind, we're not looking at any model in isolation and are drawing our conclusions towards the end of the episode. Dividend discount model, where we do see some very nice double-digit dividend growth as we saw. A bit of a letdown in this year, but however, I should be expecting personally to see a much higher percentage than we saw in January 23. On average, 12.5%, so we have gone for estimating 7.25 forward-looking. If you believe that's too optimistic or too conservative and you grab a copy, you can get your own valuation as well. DDM price then coming to $515, well above the 52-week high, above the current trading price, showing signs of undervaluation in the current market. We then move on to the third and final model, the DCF model, where we have our free cash flows year on year. Average growth rate very strong at 70%. Now, forward-looking analysts are estimating 18%. In line with that discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, we arrive at the equity value. Divide by the shares outstanding gives a DCF price of $411. Again, slightly lower now than the 52-week high, but showing signs of undervaluation to the current trading price and to the market value. Now, the intrinsic value is just the average of those models that we have just run through. And again, if you do enjoy the content, value is being provided. Smash that like button, hit the subscribe and bell to be continually notified of these videos as they drop regularly to your doorstep. Now, intrinsic value coming just shy of $400 with a current price of $342. And now viewers may be looking to see, as we do regularly review lots of these essential companies on a regular basis. And the reason why these analytics do tend to change, if we take a very quick look, now this doesn't apply to SPGI, but for the ones that do use the Graham's valuation, bear in mind the EPS does change every quarter. The growth rate changes based on Wall Street analysts, and that current yield on AAA corporate bonds again changes on the daily, so that will affect that intrinsic value. Likewise, the multiple valuation will continually change when the stock price of each of these companies changes every single day. Likewise, earnings per share on the quarter. And then we move to the dividend discount model. Obviously, this will only change when they do those increases on the dividends. But again, the growth rate is very subjective, which can change. And the discounted rate based on the free cash flow, which changes every year, alongside the growth rate, which we expect also follows what Wall Street analysts say. And we can see here the cash and total debt of the company will affect this price. So very briefly there, just run through that these prices do continually change. Now, the current price is $340. Again, 10% is what we'd use if you believe it has a wide moat, strong financial metrics, good forward-looking data. Now, for S&P Global, some people will argue that 10% is sufficient, meaning it is a buy right now up to $358. Now, 15% margin of safety, it means it is a buy at to $338, and not that far off the current trading price, only a few dollars. And those who are looking at a 20% margin of safety would say around $318. Now, personally, this is one that I will be adding into my portfolio, and you'll be asking what margin of safety. For me, S&P Global, you could justify a 10 to 15%. However, just to be on the safer side with the macroeconomic conditions worsening, I would be looking to add this, but between a 15 to 20% margin of safety. So that's 338 with 20% at around 318. So I would be looking to add this at around $330, which isn't that far off the current trading price and still within the 52-week low. Now, in terms of Wall Street, what are they expecting? Well, they see a significant amount of upside to the intrinsic value as we see here, and a lot of upside to the current trading price at 447, even higher than the 52-week highs we saw not too long ago. As always, though, do let me know your thoughts in the comments below. Is S&P Global a company you're looking to add to your portfolio, looking to sell, or even if you're purely on the sidelines speculating? Don't forget, if you want to jump in and join us in the Discord talking about all buys and sells in the markets every single day, as well as stock market and finance related queries, then do jump in with the Patreon link below. And again, if you want to grab a copy of the valuation model to get your own intrinsic value based on companies in your own portfolio to get your own acceptable buy price, click on the pinned comment below. As always, have a great day. Don't forget to hit that like button, subscribe and the bell if you haven't already. Catch you on the next episode and take care.